Most people think chaos theory is an abstract idea, something that belongs in physics, textbooks, and TED Talks. A butterfly flaps its wings somewhere far away, and somehow, weeks later, a storm forms on the other side of the planet. Cute metaphor. In global finance, though, this isn't a metaphor at all. It's a mechanism. And right now, that butterfly isn't gently flapping. It's whipping up a full-blown hurricane. While investors argue endlessly about the Federal Reserve, obsess over election cycles, or debate the latest geopolitical flashpoint, they're missing the most dangerous signal in the global system. It's not flashy. It doesn't trend on social media. It's a bond chart. Specifically, Japanese government bond yields, and not just any bond, but the 30-year. That yield has surged to around 3.5%. The 10-year has pushed past 2.1%. To most people, that sounds like background noise. Japan? Bonds? Yields? Boring. But to the institutional plumbing of global finance, this is the sound of pipes bursting behind the walls. These are levels we haven't seen since the late 1990s, and they mark something far bigger than a routine rate move. They signal the end of an era, the free money era. For more than 2 decades, Japan has been the world's global ATM. Zero interest rates, sometimes negative. Unlimited yen creation. Investors all over the world treated that cheap yen like oxygen. They borrowed it, converted it, and used it to inflate everything else. US tech stocks, real estate, bonds, crypto. If it bubbled, there was probably yen leverage somewhere underneath it. Now the ATM is effectively closed. The cost of borrowing yen has spiked. And that single change triggers a global margin call. This isn't about opinions or narratives. It's mechanical. To understand why this matters, you need to understand the game Wall Street has been playing since the early 2000s. It's called the yen carry trade. Simple in concept, devastating in scale. Imagine you're running a hedge fund in New York. You want exposure to Nvidia, Bitcoin, US Treasuries, maybe a bit of everything. But you don't want to use your own capital. You want leverage. So you scan the world for the cheapest funding source. And for years, Japan was the answer. The Bank of Japan pinned rates at 0 and flooded the system with yen. So you borrow 1 billion yen at almost no cost. You convert that yen into dollars. Then you buy assets yielding 5, 8, even 10%. You pocket the spread. It feels like free money, and when it works beautifully. Multiply that trade across hedge funds, banks, insurers, and asset managers, and you're talking about trillions of dollars. Trillions! This wasn't a side hustle. It was the liquidity engine of the modern financial bubble. But there was always a catch. There's always a catch. The carry trade only works if Japanese rates stay low and the yen stays weak. If rates rise, your borrowing cost jumps. If the yen strengthens, your debt grows in real terms. Suddenly, the math turns against you. And when that happens, you don't politely rebalance. You rush for the exit. That's what's happening now. Inflation has forced the Bank of Japan into a corner. They can't pretend it's temporary anymore. Yields are breaking out after a 25-year downtrend. The 10-year crossing above 2% is a line in the sand. It tells every leveraged player on the planet that the old rules no longer apply. So what do you do when your funding source blows up? You pay back the loan. And to pay it back, you sell whatever you bought with it. US stocks, US bonds, crypto, anything liquid enough to raise cash. This selling has nothing to do with earnings forecasts or GDP growth. It's not about sentiment. It's forced deleveraging. And forced selling doesn't care about fair value. Now here's where it gets more serious. The 3.5% yield on the Japanese 30-year bond isn't just a problem for hedge funds. It's a flashing red warning light for Japan's own financial giants. Japan is a nation of savers. Its pension funds and life insurance companies are enormous. For years, they were trapped. Domestic yields were near 0, so they had to go abroad to earn returns. They became some of the largest foreign buyers of US treasuries, European bonds, and Australian debt. Japan alone holds over $1 trillion of US government debt. But that decision was always conditional. Japanese institutions have said for years that if they could earn around 3% at home, risk-free, without currency risk, they would bring the money back. That was the threshold. We've now blown straight through it. At 3.5%, the math changes completely. Why take FX risk, political risk, and duration risk overseas when you can lock in returns at home? You don't. You repatriate. And that repatriation has already begun. So Japanese funds start selling US treasuries. Now they sell European bonds. They move capital back to Tokyo. And suddenly, there's a massive hole in the US bond market. The uncomfortable question is obvious. If Japan stops buying, who steps in? China has been selling. The Federal Reserve claims it's tightening. Domestic buyers are already stretched. So to attract new buyers, yields have to rise. Higher yields mean lower bond prices. And that pressure doesn't stop there. Rising US rates crush housing affordability. They strain banks. They expose leverage that everyone hoped would stay hidden. This is how contagion spreads. A rate shock in Tokyo forces a rate shock in New York. We've seen a preview of this movie before. August 5th, 2024, Black Monday. The Bank of Japan raised rates by just 0.25%. A rounding error, right? Global markets disagreed. Japanese equities dropped 12% in a single session, the worst day since 1987. U.S. tech sold off hard. Crypto collapsed. The carry trade unwound too fast, and everyone ran at once. That was a warning shot. Central banks stepped in and papered over the damage. But now it's 2026, and rates are far higher. The pressure is exponentially greater. If a quarter-point move caused that chaos, what does a structural breakout to 3.5% imply? It implies a liquidity shock. Full stop. And this is where precious metals enter the conversation, particularly silver. During the initial phase of a liquidity crisis, everything gets sold, even gold, even silver. When margin calls hit, investors liquidate whatever they can to survive. We saw that recently. Metals dipped as people scrambled for cash to service yen liabilities. But that phase doesn't last. Once the forced selling is done, fear replaces urgency. Investors look around and realize that the so-called safe assets aren't safe anymore. Bonds are down double digits as yields spike. Currencies are volatile. The yen is unstable. The dollar is being diluted by policy responses. So the question becomes simple. Where do you hide? You can't hide in bonds when rates are rising. You can't hide in fiat currencies when central banks are trapped. That leaves hard assets. Assets with no counterparty risk, no yield curve risk, no reliance on central bank credibility. Gold and silver fit that bill. This isn't theoretical. We've seen it before. In the 1970s, rising rates crushed bond prices, destroyed confidence in paper assets, and sent gold into a historic bull market. Silver followed, and then some. Different decade, same underlying dynamics. The carry trade blowing up isn't just a market event, it's a faith event. It erodes trust in leveraged systems built on cheap money. And when that trust breaks, capital migrates from the financial economy to the real one. So yes, the ATM is closed. Japanese money is heading home. The bond market is under strain. And the ripple effects are only beginning to show up in U.S. markets. This week, next month, and beyond, the mechanics of this unwind will dominate price action. Dollar shortages in the short term. Dollar debasement in the long term. A treasury market that increasingly relies on central bank intervention. Japan holds roughly $1.2 trillion of U.S. debt. If they sell in size, the Federal Reserve won't have the luxury of pretending this is someone else's problem. Yield curve control stops being a theory and starts being a necessity, and when that pivot happens, the implications for silver are not subtle. The bond market is the fuse, silver is the explosive, and the blast radius is still being calculated. Let's start with a word that sounds harmless, almost academic, but behaves more like a vacuum cleaner hooked up to the global financial system: repatriation. It doesn't scream crisis, it doesn't trend on finance Twitter, but in practice, it creates a very loud sucking sound. And right now that sound is coming from Japan and echoing straight through the United States. When capital repatriates, it doesn't politely rebalance portfolios. It drains liquidity, it pulls money out of U.S. stocks, out of U.S. real estate, and most critically, out of the U.S. government bond market. And that last one is where things stop being theoretical and start getting dangerous. Japan is not just another foreign investor. It is the single largest foreign creditor to the United States. Japanese institutions hold well over $1 trillion of U.S. Treasury debt. That's not pocket change. If Japan decides to sell even a fraction of that, say 10%, that's $100 billion in selling pressure hitting the bond market. Bonds don't absorb shocks gracefully. When supply overwhelms demand, prices fall and yields spike. And when U.S. yields rise, everything else follows. Mortgage rates jump. Auto loans get more expensive. Credit card rates climb. The consumer feels it immediately. Businesses feel it shortly after. The economy starts to choke. So a rate hike in Tokyo effectively becomes a rate hike in the United States, delivered without a single vote from the Federal Reserve. Jerome Powell doesn't get a press conference. He just gets the consequences. This is tightening financial conditions faster than the Fed ever could on its own. And unlike a carefully telegraphed Fed move, this kind of tightening breaks things unexpectedly. That brings us to the Treasury's worst nightmare. The United States is running deficits north of $2 trillion a year. That's the baseline. To fund that, the government must constantly issue new debt. It relies heavily on foreign buyers, historically China and Japan, to absorb those bonds. But China has already stepped back. In fact, it's been selling, and now Japan is stepping back too. So who's left? Hedge funds can buy some, but they're leveraged and rate sensitive. U.S. banks are already stuffed with treasuries and sitting on unrealized losses. Pension funds are cautious. There's really only one buyer with unlimited capacity left: the Federal Reserve. And this is the trap. If foreign demand for U.S. debt collapses because Japanese yields suddenly look attractive, the Treasury market starts to crack. Yields drift higher, then spike. At 6% or 7% interest rates, the math becomes ugly very quickly. Interest payments alone begin to consume an absurd share of the federal budget. At that point, solvency becomes a real conversation, not a fringe one. The Fed cannot allow that. They don't have the option of moral outrage or tough love. They have to step in. They become the buyer of last resort. They print new dollars to buy the bonds that Japan and others are selling. This is debt monetization. There's no softer way to describe it. It's printing money to pay the bills. Once the market realizes that the Fed is the only real buyer left, expectations shift instantly. Investors don't wait for the printer to run hot. They front-run it. The supply of dollars is expected to explode, and the value of the currency starts to slide. And when the dollar weakens structurally, people go looking for its opposite, the anti-dollar. That's where silver enters the frame again. This is why the Japanese bond story is so bullish for precious metals. Not because it's dramatic, but because it forces the Fed's hand. Even if policymakers don't want to print, even if they talk tough about inflation, they will have to absorb the selling pressure. Japan is effectively exporting its inflation problem to the United States. And there's a term you are going to hear a lot more in 2026, yield curve control. Japan pioneered it. The US is heading straight toward it. Yield curve control is when a central bank draws a line in the sand and says, this yield will not go higher. For example, the 10-year Treasury will not be allowed above 4.5%. If the market pushes it higher, the central bank steps in and buys unlimited bonds to force it back down. Infinite demand, infinite printing. This is not confidence, this is surrender. It means the central bank has officially chosen government solvency over currency stability. Inflation is no longer the enemy, rising yields are. Once YCC is announced or even credibly hinted at, the bond market becomes a zombie. Returns are capped. Risk is not. Capital doesn't stick around for that deal. It can't stay in bonds. It can't stay in cash because inflation is now explicitly uncapped. So it moves into real assets. That's how crack-up booms work. The economy may be struggling, but asset prices rise because the unit of measurement is being diluted to save the system. Silver thrives in that environment. It sits at the intersection of money and industry. It has monetary history, but it's also consumed. You can't print it. You can't cap its supply with a policy announcement. Japan's move to 3.5% on the long bond brings the US one step closer to this reality. The clock isn't ticking loudly yet, but it's ticking. Now, a reasonable question comes up at this point. Why silver specifically? Why not just gold? Gold will do well. That's not controversial. But silver has an extra layer of leverage that matters here. This crisis begins in Japan, and Japan is not just a financial power. It's a manufacturing powerhouse. Toyota, Honda, Panasonic, Sony. These companies consume enormous amounts of silver in electronics, batteries, and industrial applications. As capital repatriates and the yen strengthens, Japanese purchasing power increases. Imported raw materials become cheaper in yen terms. That allows Japanese industry to secure commodities more aggressively. A stronger yen actually boosts industrial demand across Asia. It lets them stockpile resources while the rest of the world is scrambling. So silver. At this point, the Federal Reserve finds itself staring straight at its least favorite scenario. Officially, it has two mandates: price stability and maximum employment. Unofficially, there emanates a third mandate that always jumps to the front of the line when things get uncomfortable, and that's financial stability. Right now, those mandates are colliding. Inflation hasn't magically disappeared, and the textbooks would argue rates should stay restrictive. But the warning lights are on across the financial system. The shock coming out of Japan is putting real stress on banks, bond markets, and funding channels. And history is very clear about what happens when inflation control and system stability are in conflict. Stability almost always wins. That means the Fed is cornered. They may talk tough, they may use careful language, but when liquidity dries up and cracks start forming in the banking system, they pivot. Sometimes it looks like rate cuts. Sometimes it looks like renewed quantitative easing. Sometimes it's disguised as temporary facilities with very permanent balance sheet effects. But the outcome is the same: more liquidity, more dollars. And they may do it even if inflation is still well above target. They will choose high inflation over a systemic financial crisis every single time. That choice is pure rocket fuel for silver. Silver does well in inflationary environments, but it really thrives when inflation is caused by policy failure rather than economic growth. When the market realizes the Fed has indeed defeated inflation, but instead surrendered to it in order to save the financial system, confidence in the dollar erodes quickly. Investors start to understand that their purchasing power is being sacrificed to stabilize banks and bond markets. Cash becomes a melting ice cube. And when that realization spreads, people don't argue about it on spreadsheets. They move. They trade currency for metal. That's why the coming pivot won't be a victory lap. It will be a panic response. The Fed won't be pivoting because everything is under control. They'll be pivoting because something broke, and broken systems are repaired with freshly printed money. Now let's bring this out of the macro clouds and back down to your portfolio. Why does a banking crisis actually matter if you're a silver investor? The answer is counterparty risk. If your exposure to silver lives inside an ETF, a pooled account, or a futures contract, you don't actually own metal. You own a promise. And that promise is usually backed by a bank or a financial intermediary. If that institution runs into solvency trouble because its yen funding costs exploded or its derivatives book went sideways, your claim can get frozen, delayed, or swept into bankruptcy proceedings. At that point, you're not an owner. You're an unsecured creditor standing in line. Physical silver doesn't play that game. A coin doesn't care if a bank's balance sheet is underwater. It doesn't care what the Japanese 30-year yield is doing this week. It doesn't depend on a clearinghouse staying solvent. It simply exists. In periods of financial stress, capital doesn't just seek returns. It seeks independence. Money moves away from interconnected assets like stocks, bonds, and derivatives and toward bare assets. Gold, silver, land. That's the real meaning of a flight to quality. We're already seeing the early signs of this. Premiums on physical coins have been creeping higher even when spot prices are volatile. That's not speculation. That's people waking up to the risk of leaving wealth inside a system under strain. The Japan shock isn't the fire itself, it's the fire alarm. And smart money doesn't argue with alarms, it checks the exits. In this case, the exit happens to look a lot like a vault door. So where does this leave us? Bonds are under pressure, banks are stressed, the Fed is boxed in, liquidity will likely be injected to prevent a collapse. The obvious question now is the one that actually matters. What does this mean for the price of silver in 2026? To answer that, we don't need imagination, we need memory. Every modern financial crisis follows the same script. In 2008, the banking system imploded. Lehman failed, credit froze. Silver initially collapsed, falling from around $20 to under $9 as everything liquid was sold to raise cash. It felt catastrophic at the time. Then the Fed announced quantitative easing. They printed money to buy bonds and stabilize the system. What happened next wasn't subtle. Silver went from $9 to nearly $50 over the following 3 years, a roughly 500% move. Fast forward to 2020, the pandemic hit, markets crashed, and silver dropped to around $12 in the chaos. Then the Fed injected roughly $3 trillion into the system. Within 5 months, silver was trading near $30. It more than doubled in a matter of weeks. The pattern is consistent. Crisis causes a crash. The crash forces central bank intervention. Intervention drives currency debasement. Debasement fuels a silver rally. The Japan shock fits perfectly into this template. We are currently in the volatile phase where things are breaking and liquidity is tight. The printing phase hasn't fully arrived yet, but it's unavoidable. The Fed cannot allow the Treasury market to fail. It simply isn't an option. This time, however, we're starting from a much higher base. We're not coming off $12 silver. We're starting in the 70s. That matters. A doubling from here takes silver to roughly $150 without requiring heroic assumptions. And that leads us to the macro endgame, yield curve control. Japan ran YCC for years. Now they're stepping away from it, and in doing so, they're forcing the United States toward it. As Japanese investors sell U.S. bonds and bring capital home, U.S. yields rise. The U.S. government cannot afford sustained higher yields. The interest expense becomes overwhelming very quickly, so the Fed will step in and cap rates. They will draw a line and defend it with unlimited buying. That moment marks the death of the dollar as a reliable store of value. It tells the world that the supply of dollars is infinite while yields are capped. Investors aren't foolish. They'll understand immediately that holding bonds guarantees a real loss, so they'll rotate out. First slowly, then all at once. This is the great rotation. Capital fleeing sovereign debt and moving into hard assets. And silver sits at the center of that storm because it is the smallest and tightest major hard asset market in the world. When bond refugees arrive, the price doesn't adjust politely. It disconnects. At that point, silver isn't trading on mining supply or industrial demand alone. It's trading on monetary flight. So let's talk on targets. Gold is trading around $4,500. In monetary crises, the gold to silver ratio compresses toward its historical average. In the modern era, that averages around 40 to 1. Divide $4,500 by 40, and you get roughly $112 silver. That's the conservative scenario, assuming gold doesn't move higher. If the crisis intensifies and we see visible banking failures, the ratio can compress further toward 30 to 1. That implies silver around $150. And in a true panic, a 1980-style mania where confidence in paper assets collapses, the ratio can reach 15 to 1. That puts silver near $300. So the roadmap is clear. First $100, then $150. And in an extreme outcome, $300. From current levels, that's a 2 to 4 times upside scenario. The asymmetry is obvious. The downside is limited because industry needs the metal. The upside is effectively uncapped because currencies are being sacrificed to stabilize debt. But here's the warning label. The path from $70 to $300 will not be smooth. It will be violent. As the carry trade unwinds, there will be sharp drops, $5 down days, forced selling, margin calls. These moves are designed to shake you out. Banks would love nothing more than for physical holders to panic and sell so paper shorts can be covered. When you see red candles, remember what's actually happening. The global ATM is closed. Liquidity is draining from the fiat system and flowing into the real one. Volatility is the toll you pay to participate in that transition. If you're unleveraged, if you actually own the metal, time is on your side. The only people who get hurt on a roller coaster are the ones who jump off mid-loop. Stay in your seat. So here's the final verdict on the Japanese 30-year yield. It's the pin that pops the bubble. It marks the end of cheap money. It forces global capital to go home, and it forces the Federal Reserve to print the dollar aggressively to save the bond market. For silver investors, this is the signal many have been waiting for. The macro tailwind is now blowing at hurricane strength. The industrial shortages are real. The geopolitical pressures are real. And now the macro structure has cracked. There's nothing left holding prices down except paper, and paper doesn't age well in a rising rate world. You understood the debt dynamics early. Now the math just needs time to assert itself. The yen is moving, the bonds are breaking, and silver is next. Hold steady, the repricing event is underway.